this bi-monthly session that we do, the Roundtable asset tokenization, is very generic in terms of when we say asset tokenization, talking about digital assets on the blockchain. So we have this bi-monthly panel of great people who are very much at the cold front in terms of what's happening with all things blockchain, digital assets. Probably to start off, I've got Tron there. You're the first one off the rank in my sequence. So Tron, do you want to intro a bit about you, and we'll follow with Doug and Klaus.
Sure. Yeah. So my name is TronBlack, and I got involved in Ravencoin early on as lead developer, and it's a great platform for tokenizing assets, whether they're just like gift cards, real estate. Really, it's kind of generic as far as a platform. It's code only, and so my background is technical, but I've been involved in this process along the way of kind of getting into the legal, just because there was issues around tokenizing some types of assets and things like that. So it's been quite an adventure for me to learn lots about the various markets, various jurisdictions, various different things that exist for being able to create tokenized assets.
Fantastic. I think they changed the order on me now. I think, but Doug, you go, Doug.
Hey, Kyle.
Hey, Kyle. How are you? You
What's
good?
up, John? How are you? Great to see you.
Yeah. We're just an intro stage, mate. Happy New Year. We thought it might have still been on holidays, given we didn't hear from you. So good to have you on, mate. So we're intro stage. So why don't you start?
Yes,
so Doug's next. Doug.
Sure. So DougPepe, I'm a partner at a law firm in New York called Cohen & Bresser. I'm a commercial litigator. I do blockchain law, represent clients in the blockchain space. I also teach blockchain law at GW Law School in Washington, D.C., which is a bit of a labor of love. I love doing it. I've got a few startups in the blockchain space, have a few patents, tokenizing things, real world assets on the blockchain. Tron was gracious enough to ask me to be part of the Ravencoin Foundation, so I'm on that. And that's my story. That's my basic story. I came into the space. Tron came in from the tech side. I came in from the sort of the legal side. Started out as a miner though, and went from mining to developing to sort of merging my legal practice with my blockchain practice. So
fantastic. Thank you, Doug. Klaus.
Yeah, my name is Klaus. I'm the CEO of DigiShares. DigiShares is basically a company selling a white label platform for tokenization of real world assets. We've been at it now for, I think, almost 5 years, and yeah, still going strong.
Fantastic. And Kyle?
Hey, I'm KyleSonlin. I am a founder. I'm an investor. Do some philanthropy as well. I specifically have been in the blockchain industry for quite a few years now. I spend most of my time in the securities industry with security tokens, so dealing with big data on investment banking in the blockchain environments. And yeah, looking forward to being here. Know all of you guys pretty well, so it's good to be back. Thanks for having me, Luis.
Pleasure. And yeah, I'm LuisMiguelAleixo. I'm the managing director and co-founder of BrickBC Projects. We are tokenizing real estate properties, Australian ones, on the blockchain here in of the luxury kind, the luxury for just single family homes. So it's been a journey, and we continue to build regardless what's happening in the blockchain and crypto market. So but yeah, that's a very exciting space for us all that we're involved. Yeah, look, as I was saying, we're still going to reflect on the 2002 year, just probably from the last meeting last November, which seems so far away. We just probably, as I said earlier, we were very much in the bear market then. Obviously, a lot of the negativity that was happening in blockchain, given some of the falling overs of the exchanges like FTXs and so forth. But on the positive note, in terms of our particular episode that we did together in November, just having a look at some of the stats on when we put it up on our YouTube, BrickBC. So there's 273 views so far. So I think that's people obviously hungry for information in terms of, obviously we sort of focused around real estate in the last show. So there's obviously hunger for knowledge around that space. And I know, Kylie, that's obviously that's for you know in terms of what's happening in that space, given that the major part you play in education, educating people in terms of what's happening in real estate and tokenized STOs and so forth. So and having a look at Twitter, there was around 4,200 impressions so far on that particular link that we done live. So again, as I said, I think there's a lot of hunger out there. Well, so much so that Kyle's put out a course, the first course on tokenized real estate. So he'll probably talk about that later on. So again, it's very much addressing a need, a demand in the market, as Kyle has done. So and probably just to have a bit of fun with it. And we always love to use the Mango Farm wallet that Doug founded. We actually created an NFT of the episode that I think we created 500 of them as a sub asset on the Ravencoin blockchain using Doug's platform. So if anybody wants any more, just let me know so he can share around. So again, it's just some of the things that obviously helps us all in terms of educating and using the platform, and whether it's Ravencoin or other platforms, whatever the case may be. But again, I think as an industry as a whole, I think it helps getting things out there, in my view anyway. So if you want any more, there's I've got some more. So Kyle, you got to set up a Mango Farm, Kyle.
I think I have one. I have one because of the Raven designer that made all of our PFPs, the little digital images. I set up a wallet and bought, like, I'm a whale of the pixelated profile pictures.
DM me. You'll have to DM me on Twitter, mate, so I can send the address, so I can send you some of those, so you can share around.
That's awesome. That's awesome.
Fantastic. So in terms of looking at last 2022 year, we'll go around getting people's views on this. I guess the first point I got here in terms of having a look at, from your perspective, what were some of the highlights for 2022 year? Probably go in reverse order. Kyle, you want to go first?
Well, I think that 2022, from a tokenization perspective, the biggest thing that caught my attention was the institutional banking adoption of the technology. I think that we saw so many pilot programs launch from banks like UBS, from Goldman Sachs, and what they've just brought to market with obviously JP Morgan and their tokenized collateral network, as well as their Onyx platform. You have the Bank of China issuing a $3.2 billion bond denominated in central bank digital currency, yuan. I think that just internationally, we saw a swell of the European Central Bank launching digital offerings, SocGen launching digital offerings. The benefits of settlement and clearing for very manual assets like debt or real estate, as we talk about here all the time, those are the most apparent use cases for blockchain from a financial technology. And I think for the first time, we really have begun to see true adoption. We're currently tracking over $10 billion worth of institutional debt on our backend through our data servers, which is about 50% of the current market cap, or more. Actually, it's probably closer to 40% of the entire market cap to date is actually represented by institutional debt, and that's only going to continue into 23. But I think that's great for real estate asset owners, for real asset owners, and people that are looking to get more liquidity for these assets, because these are the types of issuers that are going to need to bring that institutional capital into these types of assets. So I think it's very, very interesting to see the securities rails be embraced by larger institutions. And for me, that was the biggest the biggest, I think, banner of 22, which is why we actually gave JP Morgan our company of the year to close out the year, because of everything they've done in this space.
That's fantastic. That's I guess that's institutions will drive obviously in terms of adoption, and but yeah, that's great to hear. Doug, from your perspective.
It's been an interesting year, right? I mean, in my trajectory through crypto over the years, it's been a little bit up and down, right? And what's interesting about last year, I view last year as a bit of a period of reset, right? The tools are there. They've been out there for a while. Started with Bitcoin, pure sort of transaction in value. other chains like Ethereum and Ravencoin and others sort of expanded that into the concept of transacting other things, right? Those rails exist, and they've existed for years. They've existed on Ethereum since CryptoKitties. They've existed on Ravencoin since assets in November of 2018. You can take that sort of empty vessel, the thing that transacts on the blockchain, and you can fill it with any legal rights, right? So, Kyle mentioned a bunch of great things, securities and debt instruments, and one that's really sort of near and dear to my heart is foreign exchange, right? Huge market that has settlement counterparty risk. There's a huge bank that nobody's ever heard of called CLS that exists to eliminate that risk. That's sort of obsolete at this point. Still exists, but the rails are there to sort of put it into obsolescence. Securities, DTCC, same deal. I view last year as a period of sort of, all right, there was a lot of experimentation in prior years. People did lots of things like NFTs, sort of filling it with a copyright. That's a legal right? But same thing for a title to a house, same thing for an interest in a company, that's the security. Same thing for a debt instrument in a company, which is part of the company's capital stack. Any one of those things, it's the same technology. And while it started, with things like NFTs, started with CryptoKitties, started with things that were sort of, some in the financial industry might view as frivolous. I don't. It's starting to transition now into a period where we, I think, are going to start to see the real use case for this type of technology explode. So you've got institutional, investors coming in the space a little bit more, as Kyle mentioned. The thing that concerns me about it is, and I hope that what happened in 2022 sort of resets our viewpoint on this as an industry. And it's this. Decentralization, the whole point of this is decentralized rails. The whole point of Satoshi Nakamoto sort of solving the Byzantine generals problem and creating this peer-to-peer transaction system for value was to allow it to occur without any trusted intermediaries who could skim sort of profits off the top. And we've got away from that, I think, for a little bit, where, sort of the essential ingredient of blockchain was sort of ignored. And it just, became sort of who can make money and who can do this or that, but it wasn't the kernel that makes blockchain special was sort of overlooked. My hope is that what happened in 2022, just speaking generically about 2022, as we start to progress into the real application of these of chains for different use cases, that we focus on what, where the real bang for the buck is. We can replace a database with another database and it doesn't add any value. The real value here is doing it in a decentralized way so that all of these sort of major institutions that have grown up by taking a cut of transactions, or those that have evolved like CLS Bank or DTCC that try to eliminate counterparty risk, that they're not, sort of extracting dead weight loss value out of the system. That the system itself provides rails for people to do whatever they want with any particular blockchain asset. So that's not really addressing 2022 in particular, but I see it as sort of a trend, right? And we've gone through 2022. We've had some issues with institutions and major institutions going under. I think 2023 is the period where the gun is now loaded and we're ready to fire it, and we're going to start to see real applications. My hope is it's on the decentralized chains, and that decentralization sort of stays at the forefront of what blockchain is all about.
That's some good points there. Some good points, and I think in terms of the challenges, I think at the moment is obviously in terms of negative that's happened. Some of those institutions are going under. It's caused obviously a lot of negativity. So, which obviously we'll still go a bit deeper in terms when we start talking about the sort of 2023 year. Klaus, so obviously from your perspective, you're very much at the cold front, especially with institutions and so forth. And probably just sort of share with us in terms of from 2023 from your perspective some of the highlights.
2022 was a good year for us, a year of growth, not just experimentation, I would say, but a lot of real business actually. So in 21 we signed up 40 clients. In 22 we signed up 80 new clients. So it was double up in 1 year. And it's developers, it's asset owners, it's fund managers, it's broker dealers, it's a lot of different types of clients that we sign up that have real use cases for the technology, and not just to raise funding, but also to, I would say, automate processes, reduce back office costs, create liquidity for the investors, and so on. Huge amount of innovation going on. But I would agree with Kyle that I think the major new thing we saw was the institutional adoption, because we hadn't seen that so much before. Suddenly, a lot of institutional financial service firms reached out to us last year, banks, private equity firms, exchanges, and so on, doing POCs, sending out RFPs, and so on, really getting into the space. So we're busy with that now. I would say it's still a small part of our business, but it's a growing one. And that's new.
That's great. That's great. In terms of, from my perspective, in terms of what I saw last year, there was a huge, in terms of interest in people wanting to tokenize real estate. People that approached us that want to know what we were doing, whether it be developers or whether it be just ordinary, just everyday developers going about their own business now, looking at the space of tokenized real estate. So we were actually quite asked in terms of what we did and how we did it, and who we used, and obviously DigiShares obviously is always at the forefront in terms of, again, for us, we don't mind sharing in terms of, again, for us, the more the merrier, because we're so early, there's so much for everybody to go around in terms of tokenized real estate, that I think, the way we see things, we don't see people as competitors coming in. We see them actually as colleagues in terms of helping the industry as a whole. So if we can share, like we have, in terms of our journey and the people that have actually helped us, we'll get where we are today. It's that's what we're about. But probably one of the things that sort of stands out also on not on the negative side, but when I say negative, there's always a ways to, okay, well, how do we address it? And it was probably from a bias perspective into tokenized real estate, in terms of having to do KYC and AML. That continues to be a big challenge. Well, for us, and I'm sure for my colleagues also doing tokenized real estate, because obviously we've got to play by the rules, and the rules are you got to be verified. You got to provide your information for KYC and AML. And we probably had from half the people that register on our platform, once they then have to provide that information, they drop out. Which is quite interesting, because obviously people will provide information for things that are obviously of less in terms of Web2 spaces, and but when it comes to actually owning a piece of real estate, they sort of shy away from providing that information. Again, whether it's because obviously we are, as Doug mentioned, obviously with decentralization, this is what blockchain is obviously all about, the decentralization aspect of it, and people don't want to reveal their information because of that way of thinking, which is, like I said, we respect. We always say we respect people's views, and that's But for us, we have to obey by the rules. And at the moment, that's what it is. Because the thing is, if we want to go and actually list on external exchanges, like real estate exchanges under the DigiShares umbrella, we can't list on those exchanges unless our people have been verified. And that's the challenging thing, is you can't have your cake and eat it at the moment. That's just the reality of things. But that's one of the things I saw is sort of those couple of things anyway that I saw in 2022 from sort of our perspective in tokenized real estate. And I guess in terms of, I'll give you all a magic wand for if you had a magic wand of unlimited resources, unlimited power, without sort of getting too much on the power, given we're talking about the centralization aspect of things. If there was one thing that you guys would have fixed to help our industry, as a blockchain industry as a whole, what would that one thing be? Tron? It's your mic. Mike.
Thank you. For me, it would be just having if I could kind of fix everything, it would just be integrity and honesty within the industry. I think that was what kind of took in 22 for me was it was kind of seeing hypothecation of assets that there was kind of more existing of assets than really existed on chain. There was all kinds of kind of mixing of things that shouldn't have been mixed. So there was a lot of kind of tampering, mostly in the centralized space. The decentralized space actually handled a lot of the market rockiness and stuff that happened really quite well. And so that was the kind of the story. So for me, it would be fixing those things. And for me, it's difficult because I have this sort of libertarian streak in me. And so kind of saying, oh yeah, we need more regulation of centralized entities and more centralized entities kind of goes against my grain. But it was a kind of an eye-opening end of the year to see some of these things that would be clear, but then also trying to separate that from, there was kind of like actual fraud, and then there was which is kind of obvious and not really related to the whether or not the rules were followed. So I would fix that. I would fix the integrity of the system. And unfortunately, for the internal libertarian in me, some of that probably does come down to having some rules around it, so that people have consequences for actions when they're committing some of these things that shouldn't happen.
That's great. Klaus, from your perspective, give you the magic wand. What would that be?
Yeah, I can only add to what Tron is saying. I agree 100%. It reflects poorly on all of us that we have these issues and this fraud in our industry, right? And it's really irritating for us security token guys to see stuff like that going on, right? And it's obvious that we need more regulation and consumer protection and so on, right? So yeah, I don't have really anything else to add.
That's great. Kyle, from your perspective, magic wand.
Yeah, it's I think the rehypothecation thing is interesting too, because it's relevant to all of these different ideas we're seeing in the traditional crypto sectors as well. A lot of these licensed financial institutions are all doing these same things, and we just need to figure out how to build it in a sustainable way that aligns with the compliance standards that we're all working in. When we're talking about international jurisdictions, working with Australian real estate and trying to connect that with European investors, or figuring out how to leverage it with the US, is something that I think is really, really difficult to do in these manual industries. And I love all the solutions that everyone else has been building here. I think that it's exciting to hear the progress from DigiShare's perspective. I know that you guys are crushing it. So, I think I'm really interested to keep the conversation going. If you're all right with it, Luis, is to just ask Klaus about, from his perspective, where is the quantifiable benefit for your types of clients for this stuff? Like, are they seeing cost reductions in these processes? Are they able to leverage that yet, or is it in liquidity? Where do you think the main benefit is for some of the people that you're working with, that you're seeing actually realized in products coming to market?
I think the easiest benefit to realize is the cost reduction, right? Because we give them a management tool where they can automate investor subscription and investor trading quite easily. So that's almost a no-brainer, right? All of them can do that with our system, without interacting with anyone else, right? So that's number one, the easiest one to achieve, but maybe also longer term.
Is that easy? That's easy too, because that does seem like the biggest one that everybody wants. So it's kind of cool to hear that that's something that's doable for you guys right now.
It's easily doable, right? So it's just a matter of setting up the subscription process with e-signing and payment options, crypto and fiat to pay for the security tokens, right, and manage it on the share cap table, and also facilitate trading on a bulletin board like we provide, right, so they can do internal trading at least, also in a fully automated manner. So that's easily achievable, I would say. What is much harder to get is real liquidity, right? Can't really fulfill that yet, I would say. It also depends on partners and the rest of the ecosystem. And yeah, that's probably the main value.
Sometimes I actually find that not needing to oversimplify, right? Or overcomplicate really is the other way. Is like, I think a lot of people get carried away in some of the technological back end benefits of blockchain technology, which, don't get me wrong, are great and cool and can potentially add value. But for a traditional financial institution, do they really care about
No.
consensus mechanisms and how nodes, carry their data? Probably not, right? I haven't seen it in our case. It doesn't sound like
right up
you're in
until the
agreement with me,
bankruptcy
right? They
filing.
don't really care.
Right up until the bankruptcy filing, they don't care.
Why
2
do you say
seconds
that?
before the bankruptcy filing of their counterparty, they care very deeply. Right? I mean, that's what happened in the financial crisis. That's what blew up entities like Lehman, was counterparty risk. So yeah, they're not thinking about it, and they do not think about rehypothecation risks. I mean, they do, they're forced to, but they don't, they don't pay, at least in 2008, they paid scant attention to the real risk that was sitting on their balance sheets. A lot of banks actually didn't even understand it. And what
do you think
happened
that's
was
just short-term cause from?
What's that? Go ahead, Kyle.
Do you think that's pressure from public markets causing short-term thinking, or do you think that's would change in a blockchain environment?
No, I think it's inherent in a system that requires trust and has even on a moment by moment basis has daylight risk between counterparties to transactions, right? If you can eliminate that risk in and of itself, that adds tremendous value to the system, because when musical chairs is the best analogy, but when you're doing the musical chairs and the music shuts down, somebody might not have a chair. That's what happened to Lehman. That's what happened during the financial crisis to a number of institutions, and that's the very thing that back end piece of blockchain eliminates. So I agree, they're not thinking about it. You hear institutions like JP Morgan, the CEO says, blockchain, not Bitcoin. I don't even understand what that means. Bitcoin is the thing that created blockchain.
But where do you think the momentum comes from for those technological and regulatory shifts? Because it doesn't seem like a lot of the banks or a lot of the incumbents that are often referenced as being the ones that skim off the top. It seems like those types of players that have a majority of control and leverage in the market would not be very incentivized to change that. So where do you think it comes from? Is retail audiences really a strong enough force to drive that change, or do you think regulators will see the benefit eventually? What's your perspective?
Yeah, look, I think my magic wand would be, I think the regulatory system in the United States, that's the only one I can speak to, is a complete mess. And there is a great deal of institutional capture involved. So you have to be a behemoth institution in order to effectively do something, in industries like the securities industry on the blockchain, right? Or in foreign exchange, or, the banking system is one of the most highly regulated systems in the country, and 2008 happened. Right? We all lived through it. So regulation isn't a panacea. And I think what's happening is this sort of mishmash. I mean, Louis, you've got the Olympic rings behind you. I actually, during my class, I have a chart, a Venn diagram of all the various overlapping federal, state, and international regulations in the blockchain space. And I put an arrow in the middle of it, sort of with 15 circles surrounding it, and say, this is your client. They're asking to do a project in here. Tell them what the applicable law is. And it's a real problem, because what that does is it stops innovation in the parts of the space that really do focus on that decentralization, which is the kernel of what blockchain is. And it pushes it into the space where there's just, substantial amounts of money, huge institutions who don't have the incentive. Kyle, you're exactly right. Buggy whip makers do not have an incentive to foster the automobile industry. So, and that's why we had things in America like red flag laws, where cops had to walk in front of cars with red flags to warn all the horses. It takes a long time for that stuff to make its way sort of through the system. But at the end of the day, to directly answer your question, yes, I think retail is enough to drive it, because it's a better system than the system that we currently have. If you can have a system that doesn't have counterparty risk, you have added a lot of value to it.
I have a follow-up for you there that also I'd love to hear Tron's thoughts on, and Luis and Klaus, feel free as well. But it just kind of is following up to what you said there about decentralization being the core value add of blockchain. I'm not sure that a lot of financial institutions see it the same way. Not to pick a side on this battle, but I really would just be interested to hear, because I deal with a lot of, larger, more traditional clients, and I know that Klaus does too. From your perspective and Tron's perspective, how do you quantify the value of decentralization for a traditional financial intermediary that has to be responsible for the outcomes through their platform? When they have to identify everyone that they're dealing with, when they're responsible for the consequences of those decisions and of those business practices, how do you really quantify the reward for them to justify the outstanding risk there?
I don't think it's something that has been quantified. We're not even answering basic legal questions like, how do you put property on the blockchain? So I don't know if it's necessarily been quantified, but I'll give you a basic hypothetical, right? Two countries have exchanged between the countries, their central banking entities, whatever they may be. The old system used to be a bunch of gold sitting in the Federal Reserve, and the Fed would move it from one country's vault to another country's vault. I mean, I've seen that vault. It's right there. It's, a bunch of gold, and they used to move it with forklifts. That was a quasi-decentralized system, but it still required the Fed to move the brick of gold from one place to the next. Those systems, those sort of decentralized systems, don't exist anymore. And the classic example is two countries go to war, and one country is dependent on the other country in order to clear financial transactions, in order for foreign exchange, for whatever it may be. And country shuts down and says, you're sanctioned, you're no longer allowed to exercise any financial rights. Same thing happens in the context of bankruptcy, right? Companies go bankrupt, banks go under. During that interim time period, institutions that are interrelated with them, it's called systemic risk for a reason. It risks the entire financial system when entities are interrelated financially with each other and one entity goes bankrupt. And the reason is because the tangled web can't be untangled in sufficient time. That type of system is completely eliminated when you have T0, no counterparty risk, instantaneous transactions on chain. That's the essence of what Satoshi did. There's a reason that came out on October 31st, 2008, right in the middle of the financial crisis. Came out to address this issue. And I think we've lost sight of that. That was sort of my prologue. We've lost sight of it. And frankly, from my perspective, I teach this stuff, I practice in this area, but I'm talking theoretically. I don't care what financial institutions do. I care about what value add. I care about what value add the system brings. So
should, but
that's the difference between sort of approaching it from a theoretical perspective and approaching it from like, how do I get business? And it is the essence. And if you have a database that's controlled by 5 institutions, it's the same thing as you might as well use Venmo, because if they can turn on and shut off transactions, it's really not adding much value to the world.
Yeah, it's great points there. Sorry, John, come.
I would see that. There's two things that happened, like specifically in 2022. We have the decentralized stuff. So the amount of Bitcoin, right, never increased, right, or increased in exactly the right amount. But there were centralized entities that literally had database entries of, say, Bitcoin, where that Bitcoin didn't actually exist on chain, right? So now there's more Bitcoin than exists. So I think one of the things that's important is when we merge the decentralized and the centralized, that we have that proof of reserve, some way to be able to. And there's some kind of technical ways to do it, and some of the exchanges are doing that already, like Kraken and things like that. Basically, being able to prove that they kind of give the whole list of what they're doing, and there's a way to hash it, and kind of you can at least prove that yours is in that list and things like that. So there's some things to kind of make sure that when you have a centralized entity that's saying there's this many Bitcoin, this many shares of real estate, things like that, that there isn't more than more that exists. And there actually has been cases, and I know Patrick has brought up this one, but Dole Pineapple, they kind of stopped, and then there was all these claims against for those shares, and there were more claims than there were actually shares. We had that, I believe we had that same type of thing, and still probably have it. There's more kind of shares of Bitcoin that people think they own than actually are on chain, because all of the exchanges haven't done this proof of reserve. So I think when we bridge those two, the decentralized is like actual amount of gold, and then the centralized maybe like sort of paper gold and claims on gold and things. If you tried to reconcile those two, they would never reconcile. But I think we can do that with Bitcoin and also with securities. So I think that's important. And then the separate thing that Kyle was talking about is the KYC thing. While I may not agree with having to KYC with everything, that is the law, and there are tools within Ravencoin that allow you to do that, and also separate from the. You can actually separate so that a separate entity can be doing KYC and tagging addresses that this is Bob. We have the records, and so all the records aren't necessarily in the same place of the person issuing the tokens. So you can actually separate concerns, and the chain will kind of sort that out, and it allows. What I think is maybe, if we are going to have KYC, at least the proper separation, so that the government kind of knows that exists, but you're not necessarily publishing all this stuff to the government. And if there is an issue, they know where to go, who to get it from, and there's a kind of also sort of this electronic record. I mean, digitally signed electronic record that it was done by the entity that has the KYC tagging capability. That would be just a very, very specific entity that had that, and potentially even built into the tool set is the ability to delegate that to others. But all that has digital signatures on chain so that you know where to find it. And then those records can be paper or electronic records of that without kind of mishmashing it all together. So maybe that's my thoughts on the KYC.
Yeah, that's a good point. And that sort of brings me to my wand, my personal wand. What would I think? I mean, it's very much, if I had that personal wand power, it was actually remove KYC and AML. Because again, we're so restricted in terms of what we're doing as an industry in blockchain, whether it be in real estate, obviously, particularly in real estate, obviously there's not so much requirements in other spaces like NFTs and so forth, which could change if, again, from the US perspective, what the US, the SEC is actually sort of putting out there, NFTs might even be in that space in some years to come. But again, if I can only talk from a real estate perspective, it is restricting in terms of our industry, to grow our industry, because obviously some people just, they don't want to, because they're very much in terms of decentralization mindset. That'd be my magic one. And, but again, we got to live by the rules. It is what it is at the moment. Again, the great resources that we use, like as Tron was saying, with the Ravencoin blockchain, and obviously with DigiShares, the way they look after in terms of our platform from a DigiShares perspective, and be able to tag once people have actually been KYC and AML, be able to tag, and that follows through. Just to give a practical example, obviously, we are looking at real estate exchange, which is the secondary market that under the DigiShares umbrella, that's going to be soon, I believe. I was speaking to Mark, maybe early this year, Klaus. But again, that will follow into the secondary market. So because they've been tagged, they'll actually follow that into the secondary market in terms of being a KYC and AML verified already. So just those great features. But yeah, that would sort of be my, again, to eliminate KYC and AML. I think it's a big thing that I'll love to, but the reality is I don't think we'll ever see that, because just the way things are and the way things, and obviously when governments start talking about more regulation coming in, I think it'd be very limited. Klaus?
One way to get rid of the KYC, or at least eliminate or reduce the effort, right, is to make it decentralized and make a common standard for everyone to use. I think that's going to happen in a few years, so that should help a lot.
That would be a great magic wand.
Mm-hmm.
I also think there's intermediary ways of like.
Sorry, Kyle.
Sorry, go ahead. Go for it. No. All you.
No, I was going to say that I keep sort of putting up this dream to people that maybe one day we could have that situation with no KYC and AML.
It's going to happen.
But again, it's only a dream. So go on.
Yeah, I was thinking that I think there's another interesting intermediary option, kind of to what we've been talking about. You do see it in the traditional financial system. You see these inter-broker or interjurisdictional broker syndication networks, where basically it's a semi-private system of sharing information. And so I think that taking on a lot of what some of the Monero style of Bitcoin forks have done with using zero knowledge rollups could potentially be really interesting in a KYC environment, where you actually can leverage some sort of ZK KYC, where you could essentially whitelist an individual and have them go through a set of smart contract systems to prove their identity by leveraging open source frameworks from, database systems, and then potentially have them enter the network and exchange within the network as a private user that has been verified as an individual that's able to participate. I think that some of those things are interesting and could potentially start to solve our problem. They're semi-centralized, because you're probably going to have essentially toll gates to go on and off, and so somebody or someone has to be accountable for that at the end of the day, because you can't just have money laundering happening in securities markets. So you need to have some sort of control, but perhaps there is the option to kind of tornado cash your way through it, provided that you make sure everybody using the system is a legitimate actor, as opposed to fully decentralized, where you don't really have any controls around preventing users. And I think that's where regulators get scared, and where it just is kind of scary from a Wall Street perspective. Who's accountable if we don't know who it is that made an error?
So, but that's what the tagging is. It's basically a whitelisting. There was it actually came from, the original thing was an ERC-20 with an actual whitelist, where you're just shoving addresses into a Solidity contract. And the problem is that it just gets longer and longer, and linear search, and got more and more expensive as you added more participants that could trade the real estate or trade the equity. It just got larger and larger and larger, more and more expensive for every transfer. And so tagging is kind of that same thing. You're basically taking think of it like a token, but it's a token that you're mapping directly to an address. And I think there's actually a term for it now. Soul tokens, I think, is something similar.
Soul-bound.
But you're basically taking this soul-bound token. So you're basically taking this token and mapping it to an address. The issuer of that token and the applier of that token, the person who's applying that token to the address, has the ability to remove it, but the owner of that address doesn't, right? It's just a database mapping within Ravencoin that says that exists.
Okay. Why?
And so once you do that, there's actually
how do you make it more cost effective? What was the problem with it?
With the whitelisting or with tagging?
Yeah, because you mentioned that tagging was ineffective at scale. So how do you fix that?
No, tagging is effective. Whitelisting is not, and the reason whitelisting is not is just because of the nature of ERC-20, of tokens is you pay for the code to run, right? So the larger and longer the search is, if you're searching through a huge list, as you add, it's a linear increase. So let's say you have like 10 people that have this equity. It's not a big deal to search through 10.
Sure.
But now you have 1,000 or 10,000. Well, now it's like checking. In worst case scenarios, the guy's not in there. You're like, oh, is this address in there? And it's like 10,000 checks, right? And it's like, nope, he's not in there. That's worst case scenario.
So is that a problem of decentralization? Is that just an inherent flaw in having independent validators having to individually check users? Like, isn't that part of the value of having centralized gatekeepers, is that they can do things much more effectively at scale?
Yeah, well, with the centralization, I mean, you have the ability to just have them in your database, but you also then are like, it's kind of, well, I mean, that's our system now, right? One broker, and they have a list of all the people they've KYC'd, and you've got somebody else over here, and they've got. But built into the decentralization, or built in specifically into Ravencoin, is these addresses belong to the individual, but they've been KYC'd. Someone else, a third party, can do the KYC. And then all of the, we'll call them ATSs for legal reasons, right, that are able to verify that there's a KYC tag by somebody that they trust, right? And there's not one. I mean, anybody can set this up and use a tag called, KYCA or whatever, and they trust that tag because it's been applied by an entity that they trust. And then from a centralized perspective, they're able to accept the token because they know it came from a KYC'd address. If someone wants to withdraw it because they've swapped or traded, when they go to withdraw it, it has to be withdrawn to a KYC'd address. And even if their tech, meaning the ATS's tech, screws up, the Ravencoin has the ability to actually check that tag exists before you move the token. So the token when the issuer of the token has rules, oh yeah, you can move to any address that's KYC or to anybody who's tagged as, a valid ATS or potentially is, Reg S. I mean, there's you can use within limits logic of and they're accredited or not accredited or accredited for the first year and things like that. But those are just tags that are applied to the address by an entity that the broker dealer trusts, and then that can actually be shared across ATSs. So then you would have a situation where you have a subset of users, meaning that, people from potentially Iran or North Korea may not be able to get into that subset legally, right? But you have a subset of users that can trade these tokens actually within different trading venues without re-KYCing. And there was a big question about the legality of this. And I've talked to a bunch of people, and I'm not a lawyer, so I'm not going to say, yeah, for sure it's legal. But there are people who have actually, the guy who kind of wrote the rules for I think it's Title III of the Patriot Act, actually is doing something similar. And is allowing one KYC in multiple banks.
Well,
I'd love to hear.
Just probably give practical to that, Tron. So the Dolphin token, our Gold Coast property, was tokenized on the Ravencoin blockchain, and we've got that is tagged with the KYC now. So only people who have been verified can actually receive. So I can sell Dolphin token to you, Kyle, to your Ravencoin wallet, but because you haven't been verified, I can't. You just won't accept it. But if you have been verified on our platform, then I've got the ability to transfer it to you, sell it to you, just between us two, peer to peer. So that's living and breathing with the Dolphin token.
The one issue none of these systems solve is selling private keys, right? So in a real money laundering protective context, right? I mean, you would have fronts, acquiring KYC addresses, and those fronts then would be selling the private keys to others.
Isn't that similar though to setting up a Schwab account and saying, "Here's my password," right? I mean, that can be done today on a centralized platform.
It absolutely can. You can sell your credentials.
Fraud. They don't want to create new fraud, right?
Yeah,
that doesn't seem like a good idea.
My only point is there's a lot of regulation and a lot of effort going into a lot of these platforms and systems and KYC and all of this. And in reality, if somebody actually wanted to launder money, they would do it through the back door, and the back door is wide open for all of these systems. So it's a lot of effort. It's a lot of money. It's a lot of talking. Every panel I'm on, we talk about this issue ad nauseum. It's the first thing a client needs analysis of when they're doing a project. It's 50 state review, every state's laws on money transmission. And in reality, all you need to do is sell a private key if you want to launder money in the back door. So,
but in this case though, when you sold that private key, your name is attached to it. Right, yeah. Because you've been KYC'd. So the reason it's been tagged is because it's got your name on it. So it's not like making up a private key and then selling it, or even making up private key, getting the equity and selling it. It's having a private key, having your name attached to it, name, address, social security number, passport, and then selling it. So it seems like, at that point, it's very easy to trace that was happening.
Yeah.
Almost as easy or easier than the centralized scenario.
Well, similarly, when you can trace the transaction on the transactional side, right? So if there ever is a transaction, from whom it went to whom it went. But I don't know. I mean, it strikes me that there's a lot of discussion, time, effort, and energy on this stuff. And does anybody have any evidence of a raft of money laundering in real estate tokens in Australia? I mean, we know dollars are used to launder money all the time. And we know that the 9/11 hijackers used dollars to buy the things they needed to run the planes into the buildings. But I didn't see the 9/11 hijackers using real estate tokens from Australia. And this is what I meant about, waving the wand and having the regulatory system, sort of open itself up. We get innovation in this world because companies with no money but an idea, coming up with an idea and implementing that idea without the same financial regulations that apply to the largest financial institutions in the world, applying to them instantly in 50 different states and 4 federal regulatory agencies. If we applied the same rules that we're talking about right now, we're only talking about money transmission, to whatever Steve Jobs and Wozniak were doing in that garage in California, we would not be using our iPhones today. And we might be talking on Bakelite phones. So, I mean, I just think there's a lot of, people pay lip service all the time to all these benefits of regulation. And there are benefits to regulation, a ton of benefits to regulation. Nobody wants to see fraud. Fraud is already banned in every jurisdiction in America. And there are multiple federal statutes, mail fraud, wire fraud, securities fraud, they all cover fraud. But do we really need this level of sort of scrutiny and detail applied to tiny little startups that are just getting off the ground? There is a reason there are no crypto companies, or very few, in New York, right? Because the bit license crushed them. You have to be a major company before you can get that bit license, because it costs you millions of dollars in attorney's fees just to get the thing. And my perspective, as somebody who sort of comes at it from all different angles, is regulation is critically important, but regulate the things where there are problems, as opposed to regulate because we just regulate. What's the problem we're trying to solve? What's the regulation that will solve the problem? And how do we implement it? And right now we do not see real estate tokenization in Australia being a major problem with money laundering. Regular art, probably, right? There's a lot of money laundering in the art space. So why isn't art being regulated? But Lewis's small startup is. Why are we not regulating? It's pretty clear, right? Debit cards, prepaid debit cards, which are a font of money laundering in every city in America. But you have to KYC yourself and show a passport in order to send 500 Satoshis to someone. It just doesn't make sense, and nobody talks about rationalizing this. Everybody starts the discussion with regulations. Great.
I think it's just incentives, man. It's just incentives. It always is with regulators. Like, who's paying the super PACs? Who's lobbying? Who's providing them with any of their funding for any of their research or support? Like, it's frustrating for sure.
It is. Look,
it's always been that way. That's not surprising.
The thing is so good, John. Doug, I just say, look, regulation is good to a certain extent. Look, I've been a lifelong CPA in Australia, CPA accountant. So I get regulation. And the thing is, and I've seen over the years in different industries, especially the financial industry, and people just go over the top, and that's where we are. They've just gone too far. And the thing is, who did it really protect? Didn't the GFC? Who did it really protect? Some of these people that were supposed to be protected, did they get protected? Look, I can go on and on, but I don't want to bore you. Some of the stuff that I've seen, and again, for us, when we set out, and this is why like I said, the KYC is a massive thing, and I don't know, like I said, for us, we'll continue to push the retail space. That's our focus, because of that, we could have taken the easy way and actually focus on institutions, and basically put out a property, approach a few institutions, gobble up by 1 or 2 institutions every time. But you know what? That's not why we started what we did. We basically wanted to focus on the everyday person who doesn't get access to the ability to even invest in just a low-level real estate property, let alone something a bit more substantial. And again, it's and that's, yes, it might take a bit longer for us in the retail space, but you know what? In the long run, I think it'll, again, like I said, I wouldn't be doing this if I didn't think the retail space was going to be where I think there's going to be a lot of opportunities for the everyday person to be exposed to real estate that never have, and anywhere in the world for that matter.
It's certainly the spot where you can unlock the most liquidity, right? I mean, there are certainly opportunities there, an untapped space, I would say.
Yeah. So we sort of moved to the 2023 crystal ball in terms of what you guys see coming up. Tron, what in terms of 2003, what's some sort of the major macros you see coming for our industry as a blockchain and whole?
Well, I like how it started. I mean, it's just, I expected the contagion from, what had happened in 2022 to last a lot longer than it did. And it does seem like crypto responds a little bit faster than everything else. It responded faster on the way down, it responds faster on the way up. So I'm kind of excited about that. Excited to see stuff coming back really quick. I think it bodes well. It shows a recognition that this wasn't, this isn't a problem with crypto and tokenization, et cetera. This was a This was just a problem with fraud. And so I'm excited to see where 2023 goes. It's really did happen a lot faster than I expected, kind of this recovery and this what feels like the beginning of a bull market. So I'm pretty excited about that.
That's great. Doug, where some of the macro things you see in 2023?
The longer I stay in crypto, the more I get concerned that what started out as something with that kernel that we were talking about before is going to get turned into something that is exactly the opposite and counterproductive. So I think we're going to start to see CBDCs, programmable money, centralized CBDCs, right? So you can have two different forms of CBDC. You can have a token CBDC, or you can have a sort of a database level CBDC where, governments can turn on and shut off what people can and can't use their money on. I think we're going to see a lot more regulation in the space. I'm not convinced that regulation is going to be completely rational or directed towards solving real problems that are actually occurring in the real world of blockchain usage. I think there's a lot of misunderstanding out there about what the benefits of blockchain are and what the downside cases of blockchain are, with very little evidence addressing any of those issues. Sort of people aren't focusing on what the real practical problems are. I mean, Louis, you're doing tokenized real estate on the blockchain in America, outside of 2 counties in Wyoming. You can't even do it unless you put it inside a company and issue shares of the entity, which is not a real estate transaction. That's something completely different. Taking a piece of artwork and putting it into an entity and issuing shares of the entity is not an art sale. It's the sale of a share of an entity. So, I mean, basic questions like, how do you tokenize a piece of real property on the blockchain? No answer. Basic legal questions like, how do you actually take any sort of real world asset? How do I put my car title on the blockchain? You can't, because DMV holds the car titles. So there's just a lot of unanswered questions that are, I think, going to be ignored even longer while we all talk about the Howey test and
it's an interesting point.
Focus our energy on different things. I would like it to be the opposite, but my concern is we're going down a road where it's going to be an incredibly heavily regulated. We might even have like a new regulatory system for blockchain that really isn't focused on the problems that we have, and very little attention paid, particularly by my profession and teachers in my profession, to practical problems and practical solutions on the legal side. So, Kyle, I'm sorry.
Yeah, no, I'm in full agreement. Definitely not here to cut you off. I think it's really interesting. I think that you're bringing up a really important point, which is, I think that one of the problems inherently with our tokenization economy is that these assets are so liquid, or have the potential. Sorry if the audio is not great. It has the potential to be so liquid that it does begin to conflate a real title, for example, versus the financial asset behind the title. And those things are different, as you've mentioned. Creating an entity that holds an asset and represents economically the asset without actually representing the tangible asset or the goodwill nature of the asset and that asset itself. They are two different things, but unfortunately we can't, it's really difficult to create a framework that fairly treats them both as different assets. You almost have to assume that they are financial assets because of the fact that we are making these things so liquid that it does become a financial asset, whether or not you like it. So like, as you're mentioning, you can put a title on the blockchain right now. You can build a distributed database that is open and available for anyone that the DMV could use, as opposed to their intra network of KYC, essentially portals across all the different state jurisdictions, right? You could do that, but that, as to your point, doesn't solve the other problem of this, which is the fact that it's a financial asset. And so now you're dealing with so many different branches of regulation that it's hard for me to see there being a real solution to your problems. So we kind of just have to move on, knowing that it should be treated as the harshest thing possible, and then open up those gates as you feel more opportunity.
See, I couldn't agree more with you right up until that last point. The issue is blockchain is everything, right? It started out where everybody thought, all the lawyers, we would all talk about the Howey test, right? And it was everything is a security, and sort of like if you're a hammer, everything looks like a nail. Blockchain assets can be anything. They can be any asset in the world.
I've heard that analogy, but I don't think I buy it though, man.
Well, I mean, I'll tell you, I've had more
Like,
conversations over the
crypto
past
company.
6 years about Howey than I have about how to actually put a piece of real property on the blockchain. That's for sure.
Because a lot of them are securities, so they should be dealing with Howey.
No, a different issue, right? But the point is, we're talking about one category of assets, a very actually small and narrow subset of the total dollar value.
An investment contract that you're referring to?
What's that?
Are you referring to the investment contract as the asset class?
No.
What
What I'm
subset of
saying is,
assets?
that asset class, securities, right? That's a very small
Which
subset
one?
of actually what the blockchain can do, and there's so little attention paid to the practical issues of how do you do all of the other things, like how do you, are there benefits to putting patents on the blockchain? Are there benefits to putting car titles, real estate titles? Is there a difference between fractionalized or securitized interests in a piece of art versus fractionalized interests of a company that owns pieces of art? Is there a distinction between those two? Is there a difference between me and my wife owning our house, 50% tenants in common, and two people owning a blockchain asset that is 50% of a piece of real estate? But
It seems
in
like precedent
reality,
says that
what a
they don't
blockchain is,
distinguish, right?
what's that?
Why would you distinguish the difference between those two things? Because it seems like they're pretty similar to me.
Me too. But then we take things that are fractionalized interests in real world assets and we put them on the blockchain. All of a sudden, everybody says that they're potentially securities. So
Well, aren't they?
I'm just raising the issue because it's something that's sort of I think about a lot, and it's really rarely talked about. And it's a big problem if you want to do this practically, right? You have to have sort of a basic set of tools, and regulators and governments and lawyers in the space can't be approaching everything as though blockchain is a monolith. It isn't. A blockchain asset can be any asset in the world, and you have to treat it almost like paper. It's like paper on rails, and what you write on that paper is what determines its nature, not the rails.
What's the cost of treating everything like a security? Why is that such a bad thing?
Oh, it would be disastrous if every asset in the world was treated like a security. Absolutely
No,
disastrous.
I'm asking why. From your
Well, I don't know.
Interesting.
I shouldn't have to fill out a K1 in order to sell my Beanie Baby on eBay.
How many Beanie Babies do you own? I thought we were talking about real estate. I mean, real estate's a
Real estate too. Do we
structured
want the
asset.
SEC
Real
to
estates are
be-
bonds, right? Real estates are really just bonds that are attached to a underlying property. So
It's a good
that
question.
seems like a security to me.
Well, it's a
Especially
good
when it's
question. Do you
fractionalized.
want-
Like now we're just talking. You don't actually own the property. You just have an income generating contract. Like that seems like a security to me. I don't know why it's a big deal.
I think,
Well, no,
I think,
Go ahead.
I think too, in terms of when we start talking about obviously different countries, different laws, different states for that matter
Yeah.
as well, different laws. I guess you just got to structure a platform that'll suit what you're trying to do to adhere to that specific. Like, I'll use us for example. When I set out to actually setting up a platform in tokenizing real estate, the first thing I did was like a solid 6 months whiteboarding it, because obviously given my background legal in terms of accounting and so forth, I had to first meet all the requirements here across foreign ownership rules. You start talking about tax rules. You start talking about state taxes and some stamp duty rules. So there's a whole vast of legislations that I had to put there. Okay, do I tick that? Do I tick that? So I had to create a platform that met all those rules first, even before I started talking to Klaus. And then the next discussion was, okay, Klaus, I need something on the blockchain that adheres to these things that I in terms of my model. So again, and this is why, Kyle, we actually don't call our tokens security tokens. I call them property tokens. There's a reason why I refer to ours as property tokens, because of the model that we've actually created. And again, to be able to.
So what is that? Why don't you? Like, what is that reason why?
Because the way we've set it up is making sure that, because of the thing, we don't pay any dividends. All returns gets actually invested into crypto in the actual special purpose vehicle. So there's some things that we have to do to making sure we tick through the boxes from our perspective in Australia, but also making sure, obviously, when we went with the blockchain, adhere to some of those things that we needed, and also vice versa.
You do have an
so
SPV though, Lewis, and so you've got the whatever the property structure is, that's inside an SPV.
Correct.
Yeah.
So the token, like, again, this is obviously the agreement. So the token, the property, so for example, the Dolphin token, the benefits that it gets attached to the actual special share in a special purpose vehicle. And that's obviously our agreement. Whatever the benefits comes from that special share, we give those benefits to the Dolphin token holder, and it's a 1-to-1. So there's 40,000 of them. So
it's fungible. It's fungible.
Sorry.
Yeah.
Correct.
Sorry, Doug.
It's actually effectively a hybrid NFT property token.
Are you treated as securities in Australia under Australian law?
No,
no,
not securities. They're not securities because they're basically
fungible with a share of the preferred equity.
Correct of the share of the special purpose vehicle. Yeah. Yeah.
Okay. Interesting. I'm not aware, but interesting.
But again, we meet our laws. We basically meet all the laws from as far as an Australian perspective, and then we basically here we are. If people want to buy it, they can buy from anywhere in the world. Yeah, we obviously don't make any restrictions who can buy our Dolphin tokens. So again, probably the point I was trying to make there, you gotta cater to your own environment first, Australia, and then obviously in terms of going out to the blockchain with people like DigiShares and making sure that that meets those requirements from that perspective. Yeah.
And think about how much, this is the thing that I focus on. Think about how much money, and Kyle, this goes to your question before, what would be the downside to treating everything like a security? It's cost. Compliance with the securities laws is very cumbersome. A lot of people who are very seasoned in it get it wrong. It's super expensive. And for a startup, like Lewis, like your startup, when you first started out, it's, $50, $100, $150, $200,000 to get things in line to be able to do things the right way. If you're not selling a security, and if you're selling a fractionalized interest, which some might argue is a security, but if you're selling a fractionalized interest in a real world asset, like the 50% stake in my house, having to go through that gauntlet of the securities laws in order to be able to buy it or sell it. And in the US, you'd have to go through an ATS or a broker dealer in order to do so instead of a real estate broker. Those are real world differences between a financial instrument, like an investment contract or a security, and an interest in a real world asset, like a piece of property or a fractionalized interest in a house. And they're just two different worlds with two different cost structures, two different legal regimes. And by sort of blurring the distinction between all of them, we're making people analyze all of it for each transaction they do. And that's a problem. That's my Venn diagram with the students, like your client is here, write me a memo. That's what happens. It happens in the real world all the time. Partner goes into an associate's office, says, client wants to do this, analyze it. And boom, the associate has to go through every 50 states rules, 4 federal regulators. Crypto is the only thing in the world that, depending on what floor of the Treasury department you're in, it's either money or property, it's sometimes it gets a little bit crazy to apply all of these systems and in large measure, it's a function of how our legal system works in America, having 50 different states and multiple different sources of power in the federal government. But, for a startup to try to do something in America, I have multiple of them. There have been multiple parts of our projects that we have abandoned because it was too expensive. And I'm a lawyer, too expensive to properly deal with the legal issues. Something wrong with that. So my magic wand for 2023 is someone please rationalize it so that we're really protecting ourselves against fraud. That's the problem that's been identified in crypto. And open the doors for more innovation without people having to spend millions of dollars on lawyers before they can spend $200,000 on developers.
Yeah. And I guess in terms of, I thought sometimes sort of people like guys I speak to in the US, sometimes it's so inward looking. There's a whole world out there. And I think people sort of got out there in terms of seeing what's actually happening around the world. We can be guilty too in Australia, but again, obviously with the American market being such a big market, obviously from a population perspective and given what's happening around the world, I think people sort of need to sort of go, outside those boundaries.
Yeah, well, I mean, look, Medici Land Governance does real estate titling in sub-Saharan Africa, right? I mean, that's a classic example of just sort of stepping out and doing it in a place where it can actually be done.
Yeah, and sometimes, Doug, I think it might have, in terms of whatever that solution is, it might actually not be a solution for America. It might be a solution that's created by a US-based company for an overseas company that that really requires that. And as you said, the rules, the SEC rules in America is pretty up there when you compare to the rest of the world.
Critically important is what brings us. It's what brings the sort of the credibility to our financial markets in the U.S. But it's not supposed to be applied to every conceivable asset, nor is the CFTC's regulatory regime, right? Which if you read the Commodities Exchange Act broadly, very, very broadly, I mean, there are people who are trying to apply it in crypto in the same types of spot market transaction contexts that would govern the sale of milk at Walmart. It's just, it gets extreme. When people look at crypto, their immediate reaction is regulate, 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 without thinking about, well, if this were something with the same properties outside of crypto, you would say, there's no way it should be regulated. We're regulating oranges and trees in Howey parlance when we regulate Ripple. The crypto itself, not the offering, not the scheme with quotes, not the continuing sales of Ripple itself. If you're regulating that, you're regulating the trees and that fruit in Howey. And it just doesn't make a lot of sense. Ripple's going to be addressing that issue. And in my view, that question, I think, is going to be ultimately the Howey of blockchain, whether the underlying asset is the security or whether the security is the offering and the, sort of all the facts and circumstances surrounding it.
That's great. So looking now in terms of from your own personal perspective, in terms of what's happening in your own space, probably let's start with you, Tron, in terms of what's happening for 2023 for you in terms of some of the projects. Probably sort of mention one particular one that you're sort of focusing on for 2023.
Yeah, well, I've been helping American films a little bit with their thing for basically doing copyright protection with hashes and things like that, sort of proof of existence and things like that. So that's kind of exciting. I'm willing to help other people that are kind of in the space and have questions and things like that. So I'm kind of opened myself up to, I'm happy to do AMAs and things like that for the project in general. Kind of working with the Ravencoin Foundation just to kind of keep the ecosystem humming and monitored and things like that, and bounties for projects that the community wants to support. So that's kind of what I'm working on.
That's fantastic. Kyle, yourself in terms of 2023.
2023, it's fascinating to see. I think that we're really blending these laws, just like what Doug was mentioning. I mean, you look at Gemini and Genesis just getting hit by the SEC for issuing securities or unregistered securities due to rehypothecation. This is something that's on the exact opposite spectrum of what we see with property or fractional art or things like that also being securities. And it's really continuing to stretch what we're looking at here. In 23, we may see the conclusion of the Ripple versus SEC case, which may also add complexity, as that seems like a more cut and dry sale of an unregistered security through a fungible asset that maybe they lose, but if they win, that's probably what they're going to argue, which means that they're going to then consider all of crypto unregistered securities, or certainly a large portion of them. Anyone that had a pre-sale, I think pre-mines may have a pretty good position in that point. We've talked about that at length, Tron and I. But a lot of these tokens are then going to be considered potentially securities or unregistered. And then you look at companies like Gemini or Coinbase that have ATS licenses that are going to be in pretty good position here. So I think that there is so much on tap that I wouldn't be surprised if there's regulation that does in one way or another describe a tokenized security. However, I don't know if we're going to see any significant regulation that gives clear and definitive paths on this stuff. It just doesn't seem like that's how the SEC functions. We're still using the Howey test, as Doug mentioned, which is not even direction at all. It's just kind of a set of loose guidelines. And so at best, we would get something like that. But as I said, where I'm concerned and where I'm spending my time is figuring out where are the real monetary benefits of this technology within the financial system, and then trying to pinpoint those things. I think that some of these ancillary questions are really important, the ones that we're probably not going to see answers to. So in the short time, I'm trying to figure out, all right, we look at, Spice VC and what Tal Elyashiv has done with paying dividends of LPs and distributions on chain, right? And actually distributing out on chain payments. He's done 3 different distributions to a set of however many investors they have in their LP stack. And you look at, different companies that have leveraged the technology for like R3 and Corda, and how they're actually building different solutions for investment banking solutions. So I think that those types of things are going to be really interesting to see how they develop. Stablecoin networks are probably going to continue to drive forward because corporate debt seems like, and government debt is an interesting play here. So all of that stuff I could see definitely maintaining really strong momentum. And then all the other stuff is really fun, but I think is more elastic with respect to how liquid markets are. And certainly it seems like Q1 and probably Q2 are still going to be pretty tight. And it may continue into the foreseeable future, which I think takes a little bit of the momentum away from the general retail crowds until we see kind of a change in monetary policy. But I think a lot of it has to do with a lot of the concepts that we've been talking about here on this call. A lot of it is dictated by the regulators, and their inaction is also action to some degree, right? And by not doing anything, it kind of is also does also have an effect on the rest of the market and where the innovation happens.
Correct. And Doug, in terms of 2003 for you?
Yeah, Kyle, I mean, you raised I think a really good point that when the SEC won the Libra case, including on this question, which wasn't really front and center, but the distinction between the underlying crypto and the offering, and Ripple's coming up. I mean, I'm a litigator at heart, right? So one of the things that I'm just always keenly focused on is, where's the law going to shake out? And regulation, a lot of folks think regulation is the law. It is in a sense, but the law ultimately is decided by courts in the context of disputes. And we didn't have a lot of serious disputes in the blockchain context prior to 2020, let's say 2021. And then you got Telegram, you got Kick and Can, you got, some people who were pushing back on the regulation with greater or lesser degrees of success. Ripple's going to be an important case because it's a well-funded adversary that is pushing back. That decision is going to have, I think, major implications. I mean, if Ripple comes out, I think as Kyle said, if Ripple comes out, where the underlying token, the underlying Ripple XRP is a security as opposed to the contract transaction or scheme giving rise to the offering, then if it's the thing itself, then the crypto exchanges out there are going to have to give some serious consideration to continuing to list a lot of the things that are currently listed as cryptos, right? That will have it'll be a sea change in the blockchain space, and the reason it will be a sea change is because unless they get the ability to trade these things as securities, and if they just drop them, then a lot of those projects will just fizzle and die. And if those fizzle and die, then there won't be new ones that come along that are similar to that, right? So I mean, think about where things were in 2016 and what the major coins were. You had the big 3, but then you had other projects that came up that were innovative. Some of them survived, some of them failed. And I'm not talking about the ICOs. I'm talking about the projects that actually did things. That's all going to be lost. If everything that is a crypto, the thing itself, is considered to be a security, the bottom's going to fall out on that level of innovation. New project, somebody floats out a new project. Hey, here's some code. Everybody try it. Let's see if it works. And I think that's unfortunate. So it is my hope that this distinction between people who are raising money from other people by selling crypto assets and the crypto assets themselves, which may or may not be securities themselves, depending upon what they are in their nature, right? You can turn anything into a security, anything, beaver pelts, whiskey casks, anything, mortgages. Beaver pelts, whiskey casks, and mortgages themselves are not securities. It's the entire package that you sell when you sell an investment contract. That's my view. I hope the courts, like Judge Castell did in the Telegram case, draw this distinction, because if they don't, basically crypto is going to be the big 3, 4, 5, 6 projects out there, some of which already did ICOs and they got a free pass. And what's left is going to be gone. It's going to have nowhere to trade. You can't do it peer-to-peer because of all the money transmission issues that arise. So it will just not exist anymore. And I think that's a bad thing, because while Bitcoin isn't considered a security now, there was probably some risk that it could be considered a security back in the day when it was launched. And if Bitcoin never launched, we wouldn't be having this conversation. That was a person or people that issued an email with a link to some source code on a mailing list. And here we are, that was in 2009, January 8th, 2009, not the 3rd. And here we are in 2023 having this wonderful conversation. And I would hate to see more things like that disappear, because we're treating everything in a blunderbuss fashion like it's a security.
And you, Doug, in terms of personally, what's one particular project that you're focusing on?
Oh yeah, personally, I mean, we've got, yeah. Well, so we're about to do a transaction with our company that's going to be great. It's coming out soon. There'll be a lot more to say about that. The never-ending saga that is trying to finalize Ice Wallet, which is our cold storage wallet. For those who don't know, I see Tron and was laughing. Kyle, you've seen it too. We're there, right? We're in the final stages of doing our, sort of getting the code and building itself for production devices now. So hopefully that'll be out. Although I've said that so many times that I don't like saying it anymore. And
I'm not laughing, I'm smiling.
Yeah, smiling, right? So I've got a few things in the hopper, and also, I'm now teaching.
Why he's smiling, Doug. You know why he's smiling. He's already got his. Of course,
John's got one. No, he's got one. I have.
I look forward to mine.
I have my here. I mean, I'll show you guys. I have my Christmas red version right here.
Nice.
This is great. So, teaching. I usually teach a shorter class now. I've moved over at GW into part of the core curriculum for the National Security Studies program. So I'm teaching double time now, which is tough because I live in New York and the school is in DC. But got a few irons in the fire, and just looking forward to contributing where I can in the crypto space. My contributions are, I love it. I have a day job. I don't do this for money. I do it for love, and I'm just going to keep plodding along and seeing what I can develop and build. Nice.
Just picking up on the XRP that Kyle and Doug you made there. I do hope, Kyle, that your prediction in terms of XRP winning the case, which I think will have a massive impact on our industry in the whole. I know.
Who knows? Either way, I think it's probably better for general crypto if XRP wins, but. I don't know, man. The SEC is a tough cookie. I wouldn't necessarily bet against the SEC either.
They're not the POJ. I'll tell you, they don't have the best win-loss record, especially up in the Supreme Court.
I'm watching this one from the sidelines. No,
me too. No role in Ripple.
And the reason I say that too is obviously the massive impact. I can see some of the like the banks here in Australia, especially one of the 4 big banks here in Australia. They actually they've got a special team working on using their rails for money transfers around the world. So using the XRP rails to do it. So I'm sure they're not the only ones. And sometimes I think major banks, major institutions around the world, banking institutions, I think they're doing more than what they actually like to reveal when it comes to blockchain. Obviously, they don't want to sort of lose the support from the relevant bodies and governments in terms of given some of the governments being so negative towards blockchain. So I think they would play their game. But I think there's more going on in some of these major banking institutions what we actually know. So but in terms of 2023, in terms of from my perspective, I see I can see there's, I mean, especially in real estate, there is a lot of interest that's coming into our industry. I think they'll continue, as Klaus was saying, just in his numbers of new clients that are coming on board. Again, I think, I think it's education.
Kyle, I'm sorry, Luis. Kyle has to go, he said. So Kyle, great to see you.
Sorry, y'all. I didn't want to interrupt you, Luis. Thank you so much for having me. Hope you guys are all having a wonderful 23.
Love talking with you, Kyle.
Thanks for coming. Yeah.
Much love. See you later, y'all.
See you, Kyle. Cheers. But I just think that there is a big momentum when it comes to real estate, tokenized real estate. Again, whether that's led by institutions, and obviously with Kyle saying there is a lot of obviously interest in institutions, as with Klaus saying it as well. But again, we will continue to focus in the retail space. That's why we built what we did. It's and we've got 9 of them. We've got 9 more planned for this year. That's our vision, is to do another 9 properties this year. They'll be dictated in terms of demand. So we and our vision is always to do 20 properties each year. But this year, the vision is to do 9 more properties. Again, obviously on the Ravencoin blockchain, that's what we're committed to. But again, they'll be dictated by demand, and they'll come obviously me playing my part in continue to educate, doing these sessions with the spaces we do every week, and continue to engage with people and teaching them and telling them what tokenized real estate's all about, because it is such a foreign concept for the everyday person, who especially if you don't know anything about blockchain. Just that whole concept, let alone if you actually been in blockchain for a few years. So we'll continue to do those activities, and again, we'll really appreciate in terms of Tron and Doug and Kyle and Klaus to participate in this bi-monthly, because I think this is a way for us to keep, in terms of awareness, in terms of what's happening at the coal front, just in blockchain in general, especially in tokenized assets in particular. So I do really appreciate your time. Probably some closing thoughts, Tron, before we finish up. We've probably gone over an hour, just about over an hour and a half now.
Well,
so
I just want to say I just want to say thanks, Luis, for doing these, and I think they're informative, and I enjoyed being here and listening to the views from everybody. So it's great.
Yeah, same. Look, Tron's heard my views. We've been friends for a number of years now. Many times. But I love these kinds of discussions because it gives me an opportunity to actually express my thoughts. There are some things that you just, you don't write law review articles on, or you don't write legal articles on. And sometimes just talking about things and having people express sort of where they see things going and sort of where some of the fault lines may be, and getting differing viewpoints on those issues, I think is sort of a really, and I play devil's advocate a lot because I think there aren't a lot of opposing viewpoints on some of these questions we've been talking about. So I push. And I just think it's awesome. So, I mean, I've enjoyed this. Is the second one of these things. I've enjoyed this tremendously. So I hope we do more of them.
No, well, like I said, I've committed to doing this bi-monthly, and I just hope that you guys continue to be part of this panel, because I think there's a great way to, again, just different thoughts, different perspectives, and we're all in different spaces as far as in terms of what we're focusing, particularly every day. So to get those different viewpoints, I think it's priceless. I think, and to share it out there, and again, he's a welcome to share out in terms of the videos. Like we put it on YouTube, as I said, and also on Spotify. So the more we get sharing out there to provide this content that I hope people will find interesting and increase their knowledge in terms of what we're trying to do in our particular industry as a whole, I think it's something good. So again, as long as you guys keep helping me out, I'll keep doing it.
I'll do it anytime. I mean, thumbs up.
Fantastic. Well, there will be an NFT created out of this one too, the second one. So once we get it all out, I'll shoot those across to you and let's share it around.
Did I get the first one? I haven't checked my wallet in a while. Have I? Did you send the first one out?
Yeah, I sent it out there. Yeah, so I think I sent quite a few of them. So just share it around. If you haven't received, let me know. But
okay.
But I did share the ones I did have because I got yours and Tron's address, Ravencoin Asset Aware wallet address. So I did share those. If you want more, let me know. But there will be one created for this one. So the idea is to every bi-monthly we do, we create an NFT of it. And thank you, Doug, for storing on on the Mango Farm wallet.
No problem. Glad to do it. Minted on Mango Farm. It's music to my ears. So
Such an ease. I mean, just on a side note on that, so having a bit of fun actually, just sharing in terms of what Brisbane's about and just the places we're tokenizing. So every brick walk I do, as I'm walking, I actually tokenize the video and photos of the brick walk on the Mango Farm. Well, that's how easy it is to use. You just, as I'm walking, I'm actually literally minting on the phone.
that's why we built it. Tron knows. He knows from back, when it was first starting, that was the goal. The goal was for everybody to just be able to do it on your phone, and not just NFTs, everything, to provide the tools for people to very easily do it. So I'm glad you're using them, and I'm glad you find it easy, because that's why we do it,
Absolutely. So if you look on the Ravencoin scanner, you see these things coming up as brick walks as a starting. That's what they are. The brick walk. Dated by day. Whatever day I'm walking on, it's a brick with the date on the end as the asset name. Yeah.
Great. Okay, I'll check it out.
Fantastic. Again, thank you so much, guys. Really appreciate it, and thank you to Klaus and
All right.
Kyle, who did have to go. It was a bit late for Klaus over there in Denmark.
Yeah, he bailed, but I don't know if you saw. He sent a note saying, he had to come.
Yeah. So again, thank you, guys. Have a fantastic day. Enjoy, and we're back in was it March? The next one.
Yeah.
Fantastic. Thank you.
I'm gonna see you, Tron, on Friday, because Tron is guest lecturing my class at GW.
Oh, nice.
Yep.
Well, enjoy.
I'm excited for that. Yep, I love doing
It's
that.
always fun.
Take care, guys. Bye for now.
Okay, take care.
All right, take care.
Bye.
Thanks, guys. Bye.